What's up, everyone? Welcome to the Halo Effect podcast. It has been a minute since I have been on the show. A lot of things have happened since the last time I recorded, and I am excited to tell you all about it. So, without further ado, I'd like to get started with this episode. If you are still listening, thank you so much from the bottom of my heart for still listening and still hopping on. And I would like to apologize for the lack of consistency. However, this year has been busy, and this year has offered a pretty good balance of work and travel and a lot of things in between. And so, without a doubt, probably, and I feel like I've been saying this every year for the last couple of years, probably the best year that I've ever had in terms of all around, just business, personal, and just overall great year. So super grateful, super happy for this year. A lot of good things have been going on. It's going to be the best year in my real estate career in terms of the number of units sold, and a couple other things. However, I don't want to talk about too much about myself. I do want to talk about the success of Helo International and the real estate company and brand that I represent. We recently closed on a commercial building in Southwest Denver last week for a client who has a taco spot, a taqueria in Southwest Denver. We recently closed on that building last week or so, which is huge, huge news, a huge victory of Halo International, because we are now expanding into commercial. We are adding the commercial pillar to our business. And this year, we also added the luxury pillar to our business by selling luxury real estate. We recently, or this year, I should say, we closed on our first luxury property. Well, actually, it's not. I lied. It's not our first luxury property. We've closed luxury properties before. In terms of the price, though, it was the highest priced property that we have sold thus far. And when I say we, I am referring to me right now. But I say we because I am in the process of building something special, something that means a lot to me. I am in the process of building a team and a brand. And so I like to say we because I'm speaking it into existence. So this year, I sold a $2.45 million property in Castle Pines, Colorado. It was a pleasure to be able to help my client out, find the perfect property for them, and negotiate over $150,000 on their behalf. And so, it was a huge victory. We added the luxury pillar to Halo International this year. We're also adding commercial. We're also adding investments. Um, you know, I've helped clients look for multifamily residences, which is considered, duplex, triplexes, and quadplexes on the residential side. It is important to note that you can also purchase multifamily, you can also purchase multifamily commercial buildings that are more than 4 units. And when I say 4 units, I'm referring to the number of doors in that building. And so if it is more than 4 units, 5 units, 10 units, 15 units, 20, 25, etc., at that point, it is considered commercial real estate, and you can no longer get a residential loan to purchase that piece of real estate. And so, we are actively helping aspiring investors, first time investors, seasoned investors, purchase multifamily real estate, whether that's on the residential side of things or the commercial side of things. That is a pillar of Halo International and the services that we offer. So, how do we help with these transactions? How do we help with these goals? Well, what are the ways that we help with these goals is that we help you analyze the deal. We help you run the numbers on the deal and see if it makes sense for you. Prior to doing that, however, I sit down with my clients and I ask them questions, and I truly, try to understand what it is that they want to achieve. truly try to understand their goals, short term, long term, and then set up a plan to be able to get there for them. And so that is some of the ways, or one of the ways that I help my clients is, identifying their goals, and then looking for the type of property that they want, and then analyzing the property to make sure that we, make the best investment possible for them. So those are some of the things that have gone on this year in 2024. A lot has been accomplished, and it has felt like this year has really just been a slow and steady, year where a lot of things have happened in between. And at the same time, I look back and it feels like this year just flew, because we're already in November. Thanksgiving is around the corner. The holidays are next month with Christmas, New Year's, and we're doing a client appreciation event next month as well. So it's going to be a very, very busy month in December for us, for Helo International. And yeah, so super happy, super excited. We also added a fix and flip pillar to our brand. We helped, some of our clients get into fix and flips. We're doing some partnerships right now where we're working on a fix and flip in Arvada, and we have many more projects and things going on with the fix and flip side of things here this year. And I'm actively, coaching and teaching people and finding deals for my clients regarding fix and flip. So if this is something that interests you, make sure to reach out to me so we can get the ball rolling on that and see how we can get you started investing in real estate through fix and flipping, right? So super exciting. Some more exciting news that are, that's going on this year is we are selling and buying businesses. We help with the acquisition and the sale of businesses. We are currently selling a restaurant in North Denver by the name of Necio Mexican Kitchen off of 38th and Tejon. Very well known, very popular restaurant here in town. And we are currently selling that restaurant, that business. So if you know anybody who is interested in buying that business, let us know so we can, give them all the information that they need. So without further ado, I'd like to get into the topic of this episode. And the main topic that we're going to talk about today is a tax strategy that very savvy real estate investors use and know about. And this tax strategy is called cost segregation or accelerated depreciation. Now, if you know me, you know that, I really like to be great at the things that I do. I really work hard. I really invest time. I invest my time and energy to really understand what it is that I'm doing so I can provide the best service possible for my clients. Not only that, I'm also an investor myself. And a lot of the things that I do is to put myself in a better position on the investment side of things when it comes to real estate. And, saving on taxes is one of those strategies that a lot of investors do. And the beautiful thing about real estate is that real estate provides a really powerful tax shelter that a lot of other asset classes do not provide, right? So cost segregation is something that savvy real estate investors use to defer and or save on their tax liability every year. Cost segregation is a powerful tax strategy that allows real estate owners to accelerate the depreciation deductions on certain assets within a property. Now, a lot of people don't know this, but you can actually, when you own a piece of investment property, you can depreciate anything that is built on top of the land for 27 and a half years. The same way that you can write off the depreciation on your taxes of your vehicle, if you're a business owner, you could do the same thing with your investment properties of real estate. Accelerated depreciation cuts that time to a certain number of years. So the depreciation that you could have had over the course of 27 and a half years, you are now writing off within a shorter amount of time. And you are focusing on depreciating certain assets within the property or certain systems like, your roof, your HVAC system, your plumbing, your electrical, etc. So by breaking down a property's component into the shorter-lived categories such as personal property, land improvements, and building components, investors reap substantial tax benefits. And here are some of the advantages. Cost segregation allows property owners to depreciate portions of a property over a shorter time frame, 5, 7, or 15 years, instead of the typical 27 and a half for residential or 39 years for commercial properties. This accelerated depreciation leads to larger deductions early on, reducing taxable income and resulting in immediate tax savings. These savings can be reinvested into additional properties or other ventures. So essentially, the money that you save using the vehicle of cost segregation, the tax liability that you save, you can now use those funds to reinvest your money and buy additional assets with that money, right? Cost segregation allows you to also increase your cash flow. By reducing your tax liability through cost segregation, property owners increase their available cash flow, which means that since you are reducing your tax liability at the end of the year, you now have more cash to play with. The savings can be used to reinvest in property improvements, acquire new properties, or cover other operational expenses, supporting growth and expansion in a real estate portfolio, or even your business, or even if you want to start another business or maybe acquire a business itself, you now have more cash to play with. Bonus depreciation eligibility. The Tax Cuts and Jobs Act of 2017 introduced 100% bonus depreciation, which allows investors to immediately deduct 100% of the cost of qualifying assets in the year they're placed into service. Cost segregation identifies assets eligible for this bonus depreciation, such as furniture, fixtures, and landscaping, allowing for an even larger upfront deduction. Cost segregation provides an enhanced return on investment. The tax savings and increased cash flow from cost segregation can boost the overall ROI on a property, particularly in the early years when investors may be looking for quicker returns to offset acquisition costs. For leveraged properties, meaning a property that has a loan or debt on that property, cost segregation can increase cash-on-cash returns by making more cash available after debt payments. Again, all of these terms is just a fancy way of saying you have more cash in your pocket after utilizing cost segregation as a tax strategy to reduce your tax liability. I like to also get into the things that you should look out for when you're utilizing this strategy of cost segregation. But because just like there is pros, there's also cons when you are using one of these strategies. The reduced tax burden during ownership that accelerated depreciation gives you from cost segregation can offset income from the property, reducing or even eliminating taxable income generated by the property, right? When you cost segregate, you are tax deferring your taxes, your tax liability. So cost segregation effectively defers tax payments, allowing investors to pay less in the short term. This is advantageous for long-term tax planning as it provides flexibility and allows investors to strategize based on expected future income or tax rates. So what this is saying is that if there's a year as a business owner where you expect to make a lot more money, and so your tax liability is going to go up, you can utilize cost segregation to offset, again, some of that tax liability, right? It is important to note, guys, and what I was saying earlier about, the cons of, quote unquote, cons of maybe using cost segregation. You have to keep a couple things in mind. When you are writing off the depreciation of your investment property on your taxes, whatever depreciation you write off, and say you end up selling the property, there is something called a recapture. A depreciation recapture happens when, if you end up selling that property, all the depreciation that you deferred, that you utilized to save on taxes, you will now have to pay when you sell that property. So keep that in mind. It is a great upfront tax strategy for you to not, have to have such a huge tax liability. However, if you do have to pay that back eventually if you do end up selling that property. Uh, you know, and typically what investors utilize to, save on taxes, essentially roll, the equity from one property to another property, is a tool called the 1031 exchange. So if you perform a 1031 exchange, cost segregation may lower the depreciation recapture liability by allocating deductions to assets with shorter lives, reducing the basis in those specific assets rather than the entire property. So a 1031 exchange can help you, reducing your liability on the taxes. This helps defer capital gains taxes even further when reinvesting proceeds into another property. So hopefully that gives you an idea of, how cost segregation works and how you can use it. On the next episode, I definitely want to touch on a 1031 exchange and why that is a popular tool amongst real estate investors to not have to pay taxes on the capital gains that they get from their real estate appreciation and equity, right? Because when you own a property and it appreciates in value and you sell that property within a certain amount of time, typically, so the basic rule for a 1031 exchange is that you have to live in the property 2 out of the last 5 years to not pay capital gains taxes on it, right? And there is a limit as to how much equity you can get if you meet that criteria. For example, if you are the sole owner of that property, you lived in the property 2 out of the last 5 years, and your net profit is less than 250,000, you do not have to worry about paying capital gains taxes. If you are a married couple and the profit is less than $500,000, as long as you lived in the property 2 out of the last 5 years, you do not have to worry about paying capital gains taxes. However, if you do not meet that criteria, you essentially would have to pay capital gains taxes on the gains on those properties. And so a tool that a lot of investors use to not have to do that is they utilize what's called a 1031 exchange to essentially take that equity and roll it into their new property. Now, there's a bunch of other rules that have to be met when you're using a 1031 exchange, as far as how much time you have to identify your replacement property, how much time you have to close on the replacement property, what type of property you can buy after you sell your relinquished investment property to buy your replacement property. There's so many, things that you have to, so many criteria that you have to meet. And so in that event, it's very important to work with a 1031 intermediary because they essentially help you through the process. And so that's definitely something I'd like to touch on next. But for now, this episode was around cost segregation. So I hope that this episode was beneficial for you. And, make sure to follow me on all social media platforms. Reach out to me. I'm more than happy to help you and guide you with your real estate goals and set up the right plan to help you succeed in real estate and develop your real estate portfolio. So with that being said, thank you for hopping on to another episode of the Halo Effect podcast. And I will be dropping more episodes, especially as 2025 rolls through. A lot of big plans, a lot of big goals coming for 2025, and we're ready to make it happen. Let's go.